on, you will be facing a variety of financial decisions, big or small. Hope this talk can help guide you through this journey and make you feel more confident and in control of your finance. The goal of this talk is to help you making financial decisions to lighten your financial burden, being mindful of your finance and put you in the best financial spot. Also having direct and lasting impact on your financial health for the rest of your life. There's a very popular term among the young people called FIRE. It's a financial independent retirement early. It's a program of extreme saving and investment that allow you to retire for much earlier, say 40-something. And hopefully this talk can make it easier for you to reach this goal. So next agenda, this talk we will cover basic banking system, build out your credit score, be budget savvy, and understand retirement account. Because after you join the company, you have to select the different kind of retirement account, how you to select that, and learn basic tax filing and get started on investment. I know there are lots to cover. I will only cover some basic concept here, but more details for each topic are covered in our Golden Parachute YouTube channel video. However, they are all in Chinese, but slides are in English. So welcome to go to that channel to check it out. Okay, first, banking system. You can divide the whole banking system by retail banks and investment banks. They are separate two categories, provide different financial service. And actually, there's a war between these two systems, even under the same big family. For the retail banks, you open a bank and to put your money in a safe place. The account type, they do two types. It's called checking account and saving account. Checking account is to use money. You can deposit the money like your paycheck, and then use that money to make a payment or withdraw. Make sure find one is insured by FDIC. The coverage you up to $250,000 per account. And you also should get some debit card that allow you to make purchase and withdraw cash at the ATM machine. However, some banking account sometimes will come with a fee, such as a monthly maintenance fee, overdraft fee, or ATM fee. So you should be more careful, make sure read the term. And saving account is to save money while earning interest over time. But now the rate is pretty low, so you probably don't consider doing this. And retail banks also provide some financial service, like a loan money, like a car loan, student loan, or if you buy the house, a mortgage, you get the loan from the bank. And they also provide some credit card to build up your credit. We will talk about credit card later. And also they have some interest income type of investment service, like they will provide money market fund, CD with a higher interest rate than the saving account. The typical retail bank like Chase, Bank of America, Wells Fargo, Credit Union. Okay, the next one is the investment bank, is to invest money. Basically, investment bank act as a middleman between the bond or stock issuer and the investor. If you want to put money to invest, then you need to open a brokerage account to put the money to invest. And also you can open a retirement account in the investment bank. So, but make sure one issued by the SIPC insurance. Coverage is up to $500,000 per account. You also open the IRA account in the investment bank. So if you want to invest money, you shouldn't open the account in the retail bank, like checking and saving. You have to open a brokerage account under the investment bank. And investment bank also provides some financial services like a trade, bond, and stock, and personal financial planning. And then if you don't want to manage your asset, they can help you to manage your portfolio. Famous one is Charles Schwab, Fidelity, Bank of America, Merrill Lynch. Bank of America is retail bank, and their investment bank part is called Bank of America Merrill Lynch. Chase is a retail bank, and their investment bank is called JP Morgan Chase. So they are different. Okay, next we'll talk about the credit score. A credit score is a 3-digit number that particular is a prediction of your credit behavior by these 3 major credit bureaus. The higher credit score typically means that you are at a lower credit risk. So you can get lower interest rate and more favorable return. But lower credit score can result in higher interest rate, higher fee, or even being denied. So to understand how does the credit score calculate can help you to understand how to build up your credit score. So the calculation here is 35% most weighted on the payment history. So pay on time. Also very important is to pay in full. Definitely not borrow money from the credit card because credit card's interest rate is super high. It's above like 20-something percentage of the interest rate. And 30% is how much your debt. It's based on the entire amount you own. Also, the proportion of the money you own compared to how much credit line you have available. It's better keep the number below or under 2%. And 15% is the length of your credit history. This do take time to build up. So the early, the better. Some people suggest paying everything by cash and don't apply credit cards. But this will also hurt your credit score if lenders have no credit history to review. And 10% is type of account you have, and also 10% is the new credit activity. This is like people always say, number of the hot pull. It's number of the time people or institution checking your credit score. If you have opened or applied a lot of account, the bank might think that you have a potential financial trouble and can lower your credit score. It's also important to check your credit report regularly and to make sure all information is accurate and up to date. You can also monitor your credit score through your bank that issue your credit card, like Chase, Bank of America, and Wells Fargo. Okay, so the credit card, now we talk about credit card. Like I mentioned before, you should apply credit card to build up your credit score. And here are the type of credit card to choose from. The level, they have entry level. Their entry level have no annual fee. You can get a point or cash reward. Or mid-tier, the average annual fee is around $100. They not only got a cash reward point, they also got a sign-on bonus. High-end, the average annual fee is $500 and also come with other perks. Credit card reward point platform, there's 5 major credit card reward point. One is Chase Bank, it's the ultimate reward point. And American Express is a membership reward point. And Citibank is a thank you point, reward point, and Marriott Bonvoy points. Capital One is Capital One points. So this is 5 major credit card reward points. And there are 3 major airline alliance, like Star Alliance that has EVA Air, United, and Singapore. And One World Alliance, like British Airline, Japan Airline, Alaska Airline, and SkyTeam Airlines. They are Delta, China Airline, etc. So these 3 major airlines, a very popular travel point exchange example. People like transfer the Chase United point to the United Airline travel portal and use the United Airline reward point to book EVA Air and fly back to Taiwan. Because EVA Air and United Airlines are Star Alliance. So you can exchange the point to book a different airline within the alliance. And also there are some hotel points. You have to apply their hotel credit cards to accumulate their hotel reward points. Now we talk about accumulate points. is spending. You spend $1, you get 1 point. And some credit card will provide 2 times or 3 times or even 4 times the point reward. Like Costco, if you use a Costco credit card to put on gas, $1 you will get 4 points. And if you use the card to pay your restaurant or travel, then $1 you will get 3 points, etc., to accumulate all the points. And redeem points is how you cash in the points. Like 100 points is similar like $1. So use the point to redeem airline ticket or hotel stay, like I explained before. You can also purchase. You can also purchase through their shopping portal, but not recommend because that's not a very efficient way to use the point. Also use the point to pay off your statement bill. So collect all those travel points can save a lot on your travel expense. Give you example, last year we went to the Europe, 17 days, 3-country Euro trip. We use a point to redeem airline ticket and some hotel stay. So total cost is around $1,900 per person. So actually it's really save a lot, okay? And then the next topic be the budget savvy. The key point of a budgeting is you have to base upon your income source to set up your budget plan. So let's do first is the first step is to identify your income source. Your salary come from your salary, part-time job, bonus, or your investment like interest, dividend, investment income. That's the income source. You know how much you earn. And then set up your budget plan based on how much you earn. We will talk about 50-15-5 savings spending rule of thumb in the next slide. Okay, you should use the spreadsheet. You can use the spreadsheet or some online apps to help you to understand how much you should spend on the housing, car payment, or dining out. And the step 3 is just keep track of your spending and set alarm. So the income minus your spending. If it's under, then that means you spend more than you earned. You should see the big red light. No, you should either boost your income or to lower your expense. Then if it's balanced, then basically you are living paycheck to paycheck. You should see a big orange light. No good either. You cannot save money and put the money to work. If it is a surplus, good job. Then you can decide that if you want to save or invest surplus money for the future, or you want to reward yourself now. That way you can put and immediately stop the money leak and stay out of the store that steals the money from your wallet. So most important is to develop a habit of knowing exactly where your money goes. And the step 4 is to revisit your budget and make a change accordingly. 2 areas you should focus on. First is to see which area you overspent, cut down, and stick to it. And also identify which part you actually spend less so you can save and invest more. So we talk about this 50-15-5 rule of thumb. This is a Fidelity recommend the saving and spending rule of thumb. So 50% essential expense, your need, consider allocate no more than 50% of your takeaway the pay to essential expense that covers the housing, food, healthcare, etc. There is a balance of personal choice. So if you live in a very expensive apartment, drive a very nice car, then you need to cut back on the eating out and new clothes. So the total of this item do not over 50% of your take-home pay. So you earn more, you can spend more. But if you earn less, you better control your spending. And 15% or maybe more for the re-tax income saving for the retirement, like a 401k traditional or Roth IRA. We will talk about retirement account later. And 5% is for the unexpected expense. Let's say have enough put aside in saving to cover 3 to 6 months of essential expense. So now question 50 plus 15 plus 5, not 100. So what do you do the rest of the money? Well, it's really up to you. You can increase your retirement saving from 15% down to even 30%, or put money into investment, depends on your financial situation. So the main goal of this rule is to make sure you have a saving for retirement and also building an emergency fund. So key point here is saving before spending, not the other way around. Now, people usually like spending as you wish, only save if there's anything left. Okay, the next one we'll talk about is the latte factor. If we add up the cost of our daily unnecessary spending and save and put into investment, we could build our wealth significantly faster. Use this example. If you spend $7 on a cup of latte and every day over 35 years, guess what? You will end up saving up to like $89,000. Instead, if you choose to invest in this $7 every day, 8% of the average rate of return, you could earn this amount of money in the interest. This would bring the real price tag of a daily latte over 35 years to this number is $488,000. So the question you should ask yourself, is that worth it? Is this really necessary? Or why spending that money on the $7 a latte every day? So be mindful on your spending. So latte factor brings us 7 key points. First, compound interest. And then time, our example is 35 years. Rate of return, our example is 8%. And more than latte, it's everything in your life. So more than important is to build a good habit and differentiation between what is your need versus what you want. And practice self-control. And small amount do matter. Every dollar we can save and put to work for us will compound if given enough time. So that brings us to next big topic is financial planning. Actually, my friend forwarded me this live equation. So happiness is equal what you have divided by what you want. The more you have and the less you want, the greater your happiness index will be. So when you are young, you should try hard to accumulate what you have. Not necessarily only the material stuff like money, car, house, but also the good relationship with people, your hobby, your passion, your interests, and how to make what you have. Before we talk about saving and budgeting, now let's talk about how make money to work for you. And this is a financial planning equation. When you just start working with the right and good budget, we mentioned before, your income, your salary, you walk your income minus the tax you have to pay and minus your expense, and then save all the plus. Over the years, your income plus the saving on the retirement account and then investment, the brokerage account for the investment, and then tax and other saving like HSA to save your medical bill, and tax saving on the healthcare dependent. And then you can cover your daily expense. And one day when you don't have work, you don't have salary, all this income, you're saving and passive income from the investment account or brokerage account, minus the tax you have to pay, bigger than your daily spending, then you just achieve the financial independence. That is, you can retire and no need to work for money. You can work for your hobby, but now you don't have to work for your money. So we will cover the retirement account and then the investment and also the tax. These are 3 big topics. Here comes the most complicated but very important topic is a retirement account. There are a couple different types of retirement account. First, let's clarify some terminology. When we talk about you put the money into the retirement account, there are two parts. One is contribution. That's the money you deposit into the retirement account. And also the gain. The gain is you earn the money from your investment. So for the employer sponsor retirement plan, there are three types that provide, this is a retirement account provided by the company for their employee. Although it's employees' own money, but they are under the name of company's trust. And the company has its own investment option and rules you have to follow. And you have to check with the HR to see your company, the 401k retirement account, the option, the investment option, and the rule. So there are three types of retirement contribution within the company retirement plan. The company 401k plan will label those contributions differently. First is 401k. This is a pre-tax contribution, and then tax deferred on the gain part. Gain part is tax deferred. Tax deferred means you don't have to pay tax now, you pay tax later when you withdraw the money. So every dollar from this contribution will have to pay tax when you withdraw. Second is Roth 401k. It's used post-tax, the money you already pay tax contribution, and then tax-free on the gain part. So this dollar, all the money from this account is tax-free when you withdraw. And another one is after-tax contribution. Again, the same, it's a post-tax money, post-tax contribution, and it's tax deferred on the gain part. So when you withdraw this portion of the contribution, you have to pay the tax on the gain, the money you earn from the investment. So under the same account, same investment selection, they just label a different source, whether it's the pre-tax or after-tax. We will explain this later in the detail. If you leave the company, then you have three choices. First, you keep the money in the company's retirement account and continue to invest. Or you can transfer or roll over your money to your own retirement account, IRA, outside the company, and to management it yourself if you know how to make investment. Or you can roll over and merge into your new company 401k retirement program. Some people transfer money to their outside IRA account and after leaving the company, but leave it there and do nothing. What a pity, because always stay your money in the market. For that kind of case, then it's better you just keep the money in the company 401k if your previous company 401k program provided by the good investment bank, and continue put the money investment in the market. Okay, the second one is they call IRA, individual retirement account. A retirement account open at the investment bank like Charles Schwab, Fidelity, and management by yourself. You management your retirement money. Like 401k, there are three types of IRA account. Traditional IRA, just like a 401k, and Roth IRA, just like a Roth 401k, and non-deductible IRA, just like a company after-tax contribution. They are all same. We will explain them in the detail later. And another term to explain here is rollover. So you transfer the money or fund between different retirement accounts. We call it rollover. If both accounts are with the same type of tax rule, like pre-tax, after-tax, tax deferred, if they are the same, then you don't trigger the tax event. Like if you roll over 401k to traditional IRA because they are the same tax rule, then it's called rollover. Or you roll over 401k to another 401k or traditional IRA to the 401k, they are with the same tax rule. So there's no tax event. We call it rollover. Another term is called conversion. If you transfer fund to account with different tax rule, like pre-tax to after-tax, after-tax to free-tax, then it will trigger a tax event. Then you need to do the some tax calculation. We will call it conversion. Just transfer from transfer from traditional IRA to Roth IRA, the different tax rules. So you will do the convert because you transfer money from a tax deferral. The traditional IRA is tax deferral retirement account, is pay tax every dollar, to a tax-free. Roth IRA is tax-free. So then you need to calculate the tax you have to pay when you file that year tax return. There will be more detailed explanation when we talk about the tax filing. And the reason why the retirement account is so powerful is because their tax deferred benefit. We know we have to pay tax on almost every dollar we earn, whether you pay now or you pay later or you don't have to pay. And then retirement account belong to these two pockets, either pay later, that we call tax deferral, or tax-free benefit. So save the money that you are supposed to pay to the IRS into the retirement account to invest. Use the compound interest power to let it grow, and wait until you retire. Your tax rate is lower to withdraw the money. That's why we say retirement account oftentimes is the key element to decide if you can retire early or become financially independent. This picture shows all different types of retirement account. This middle line refers to this is the inside the company retirement account, and this is the outside. This part is company sponsored retirement account like 401k, and this part is the individual, the IRA account outside the company. It looks like very complicated. Don't worry, we will guide you through slowly and explain their difference. There is a limit to how much money you can deposit into a retirement account posted by the IRS. This is a 2023 retirement account contribution limit. So for the 401k, you can deposit $22,500 a year. And then for IRA, you can deposit $6,500. Company 401k program, you can deposit or contribute money to either 401k or Roth 401k. Okay, 401k is to contribute the pre-tax money. When we say pre-tax money, that means you don't have to pay federal, state, local tax. And the gain part is that you make the money to investment. The gain part are tax deferred. That means you pay the tax later when you withdraw the money. So every dollar from this contribution will be taxed when you withdraw the money. Versus a Roth 401k is you contribute after-tax money, which means you pay the tax already, the money. And then the gain part is tax-free. So every dollar from this contribution, you don't have to pay tax when you withdraw it later. So question you may ask is, should I contribute money to 401k or should I contribute money to Roth 401k? Basic rule is, if you are high pay, like say more than $50,000, your tax bracket will be high, like 22%. So you should consider put into the 401k. So you take the deduction first and pay the tax later when you retire, and then when your tax bracket is low. So when your income is low, like a summer internship job, then you should contribute money into the Roth 401k because your tax rate is low. With a standard deduction, you probably don't even have to pay tax anyway. So, okay, now let's talk about this complicated one. It's called after-tax contribution. Nowadays, more and more companies, especially high-tech big company, also provide employees with an after-tax contribution that you save even more extra money. The contribution is after tax. It means the tax, you already pay the tax. And the gain part is tax deferral. So you pay the tax when you withdraw. How much you can contribute after tax money to the after tax contribution? Okay, IRS have a rule that every person can save up to $66,000 per year for year 2023. Doesn't matter you contribute the money to any combination of the retirement accounts. So let's say if $66,000 minus your 401k contribution, 22,500, and minus your company match amount, that is the maximum amount of your after-tax contribution you can make. So after-tax contribution are post-tax money, so money you already pay tax, and only tax on the gain part. It's the gain part is only that you have to pay the tax. So when you make the contribution, after the contribution, and then you convert or relabel the money to the Roth 401k right away, right after you make the contribution, then there's no gain yet. So there's no tax you need to pay. So basically you convert or relabel the money from the tax deferred to the tax-free right away. So we call this special step called backdoor conversion. The amount is big, so we also call it mega backdoor Roth conversion. Usually, if you are still working in the company, the money in your company retirement account, you cannot be transferred or roll over out until you leave the company. But there's an exception. That is, you can roll over the portion of the Roth 401k that you just convert from the tax after-tax contribution to your outside Roth IRA. This part, then we call it in-service distribution, but only the part that you convert from your after-tax contribution, not the Roth 401k contribution part. So with this company benefit, you can have a chance to save a lot more money every year. You can bump your saving from, before we said you should have 15% pre-tax saving for retirement, you can bump it to 30% easily. You definitely should make good use of this benefit to accelerate the accumulation of your wealth if your company did provide this benefit. So do check out with your HR to see if your company provides this after-tax contribution. Okay, sounds very complicated. Let's see this. Use this chart. This 401k source allocation pie chart probably is easier for you to understand. So under the same 401k account, same account with the same investment selection, they just label the different type of contribution with a percentage to indicate how much percent of the money are pre-tax money and how much percent of the money are after tax. For this case, those labeled Roth are post-tax contribution. Total here, there's a 3 Roth contribution. So total is 2.666 tax percentage. This is tax-free. So when you withdraw the money, it's tax-free. You don't have to pay tax. But among your 401k program, there are 97.34% are tax deferral. So, so when you withdraw money, they will based on this proportion, this percentage to calculate your tax. And among this Roth, there's only this label. When you label to be Roth IPC, this is a portion you do the Roth conversion, backdoor Roth conversion. And this portion, this percentage of the contribution, you can roll it over to outside your Roth IRA called in-service distribution. So this is how they know percentage of the pre-tax money, percentage of tax after-tax money. So the whole account will grow and shrink proportionally based upon all this percentage. I hope this explains about the whole company sponsor the retirement account. It's very complicated, but that's very important too. So how about the company? If your company, because not all the company have this after-tax contribution. So how about if your company does not provide after-tax contribution? So can you save more? Yeah, answer is yes. Okay, everyone can save $6,500 into the IRA, the outside IRA account. Doesn't matter if you join company 401k or not. We have mentioned before the IRA also have 3 types, like a company. We have the traditional IRA is pre-tax money in and then gain on the tax deferral, the same as the 401k. And the non-deductible IRA is similar like the after-tax contribution. Your money is after-tax contribution and then the tax on the tax deferral. And then Roth IRA is after-tax contribution and then tax on the is tax-free on the gain. So which type of IRA account you can contribute, like $6,500 really depends on your modified AGI amount, your income based on your income. If your company do not provide 401k or you did not join company 401k, then you can always contribute money to the traditional IRA. There's no income limit. If you do join the company 401k, then there is a limit, the income threshold. Let's say if your modified AGI less than, for the singles less than 153,000 and couples less than 228,000 for year 2023, then you can contribute money into the Roth IRA. Okay. Otherwise, you have to contribute money into the non-deductible IRA, like the company after-tax contribution, the non-deductible IRA first. And you do the same backdoor conversion, just when you put the money into the non-deductible IRA and then transfer it or roll over or convert it to the Roth IRA account right away, because at that time you don't have gain yet, so you don't have to pay tax. Remember, for the non-deductible IRA is the post-tax money, post-tax contribution, but gain on tax on the gain part. But because you just deposit the money into non-deductible IRA, so you don't have gain yet, and then you do the conversion right away, so you don't have to pay the tax. The same thing like what we did on the company after tax contribution, the makeup backdoor conversion we had mentioned before. So in addition to your company 401k contribution, you can save, everybody can save extra $6,500 into the IRA account. Okay, there are some company 401k program tips. First, make sure maximize your contribution. Statistics show that only about 12% of the people in the United States maximize their 401k contribution. If you want to be early financial dependent, then you should make good use of the retirement account to force yourself to save money. And then also the company match. You know, company match is free money, so never let go free money. Keep in mind that company match is calculated based upon the total amount of your contribution. The more contribution, the more free money you can get. Also, company match will go to the 401k, which is a pre-tax contribution. Even if you pick as a Roth 401k contribution, but the company match still go to the 401k. So check with your HR if a company have this company match benefit. Investment, put the money to work. We will talk about investment later, but when the market is up, when the stock market is uptrend, because you put the money in retirement account, you definitely put the money into invest. So when the stock market is uptrend, you should consider putting as much money as possible into market, because when the stock market is going up, you will buy stock more and more expensive. So the earlier the money enter the market, the better. Some companies allow you to deposit up to 40% or even 90% of your paycheck. Timothy's summer paycheck all go to his Roth 401k, except tax holding. So when the market go down or is uncertain, then you should consider the average cost to enter the market. The total calculation amount divided by 24 paycheck. Because when the market going down, you will buy the stock cheaper and cheaper. But well, but you have to learn if the market is uptrend or downtrend. So you have to learn the investment. But for young people, now it's always the lower than compare with the 30 years after. Okay, finally finish this most complicated topic. I hope you guys still on track of what I'm talking. But let's look at the next topic, basic tax filing. So in the US, almost every dollar you earn is taxable. Let's look at this tax picture again. Every year, the federal personal income tax filing is under this tax now pool. You have to file tax and pay the tax now. And any income you earn for this year, include your wages, your salary, your investment income, or you sell your property. So let's check how to file personal income tax. The tax required document, 3 categories. First is the income tax form. Income tax form, every year, end of January, you will start receiving tax form from whoever or wherever give you the money, like company, bank, school. Those tax form can be either for tax filing, because you file tax, or for the information only. So the tax filing, basically the form tells you how much money, how much income you earned this year, and how much tax withholding those companies had to pay to the IRS. And information tax form is basically to keep the record for the future reference. Like we said before, the after tax money, you don't have to pay tax now, you have to pay tax later. And that form tell you how much you have to pay later to calculate. And second one is tax filing form. You file all the tax data from those income tax form to the IRS filing form, like 1040 Schedule 123. This is IRS tax filing form. And then fill up all this IRS tax form and file the tax. And the third one is tax report. All this company or financial institution, they send you the income tax form. They also send the same copy to report to the IRS. And IRS will cross-check the data from the company and also the data from your tax filing. If they are the same, you are okay. If they are not the same, then you will get an email from the IRS, and then you have to explain why they are different. So key point here is make sure the data consistent. The data from the institution and the data from your filing tax return are the consistent. If not, then you will get a red flag from IRS. And also another is no big data change. IRS doesn't like big change. So make it consistent. And if there's a big change, it's easier to raise the big red flag. And another important part is keep all the receipt and tax record. Keep all of them in case the IRS will audit. And it's better to keep in electronic format, save it on your computer. Okay, let's check on the how to file tax. First, the first step is the gross income. You have to sum up all your gross income and then minus your adjustment. The adjustment basic is we call pre-tax money. The pre-tax money is you don't have to pay federal, you don't have to pay state and then local tax, and even the FICA. And then minus the adjustment, your gross income minus the adjustment, you come out to the adjustment gross income. And adjustment gross income minus the deduction and come to the total tax income. And tax income, use the tax income to find out your tax rate. Where is your tax rate? And times your tax rate, come out with the tax amount you have to pay. And check if you have any tax credit. The tax credit is a dollar-to-dollar deduction, which is more effectively reducing tax balance than the deduction. We will talk about that later. And you tax amount minus tax credit, and this is tax liability you have to pay this year. And then to check how much you already prepaid, like a company will withhold or institution will withhold the tax, how much. If you withhold more than your tax liability, then you get the tax refund. If withhold, less than the tax liability, then you have to pay tax. So 3 key areas you should pay special attention to help lower your tax balance. First, adjustment. Second, standard deduction, and then tax credit. And sometimes you have to plan ahead. If you wait until when you will file tax, then there's not much you can do. Right? It's already after fact number. So let's talk about adjustment. Adjustment is that we call pre-tax money. And pre-tax means you don't have to pay federal tax, state tax, local tax, and FICA tax. So this is the most important area you can add that, and then to lower your income. Like 401k, the IRA, the pre-tax contribution, then they will be added into the adjustment. But pre-tax, the 401k, the retirement for contribution, they have to pay FICA. These two, the health saving account and flexible spending account, this two is adjustment, and you don't have to pay the FICA. So check with the IR if you have this kind of program like a health spending account and then flexible spending account. These are included in the Schedule 1, Part 2. Okay, and then deduction. This is the year 2000 deduction, year 2023 deduction. Deduction basically reduce the amount of the income on which you are taxed. This is based on different filing status. In easy words, like first for the single, the first one $13,850 of your gross income, you don't have to pay tax. Okay, now we talk about this paycheck. You have to understand the paycheck because there are lots of tax data on your paycheck. So you check it on your paycheck. First, the FICA. FICA, we also call it payroll tax. Every paycheck, the company will deduct 6.2% of your paycheck for your Social Security benefit, and then 1.45% for the Medicare. Employer, your company, also will deposit same amount of the money to the Social Security benefit or Medicare. This is for your retirement benefit. So when you retire, you can get the Social Security benefit and the Medicare medical coverage. And also, there's a federal state tax withholding. There's a prepaid your tax, and state disability insurance, and medical or dental healthcare premium, and 401k contribution. So in your pay stub, they have all this information show. Okay, for medical or dental healthcare premium, this adjustment, this is a pre-tax money. You don't have to pay tax on the premium. You have to pay. And 401k, same thing. You don't have to pay the tax, federal or state tax, but you have to pay the FICA tax. And then, so this following example, I give you a very, I grabbed this from the online. This is an example of the pay stub. This is example now, year to date, their wage is $900. And he has a premium for the medical and health and the dental premium. This is the adjustment. You can add that. Also, if you have the HSA contribution, you also can add that into the adjustment. And then he make a $27 at the retirement 401k contribution. So by the tax year, he will get the W-2 form. On the W-2 form, you can see that for the FICA, for your Social Security wage, is the $900 minus adjustment, minus this premium he has to pay. So for the security wage is $757. But for the income, the gross income is only $730 because he also deduct the retirement account 401k contribution $27. So this is the tax information. So from the tax, you can know from your pay stub, and also by the tax year, you will get this income tax form W-2. Okay, we use example is easier to understand. For the single, his salary is $100,000. he make a 401k contribution, $22,500 as his adjustment. Okay, minus a deduction. He used a standard deduction for single is 13,850. So the total income will be the $100,000 minus adjustment minus deduction, and this is the total taxable income. And find out, use the taxable income to find out where is the tax rate. His tax rate is 22%. So this is the amount he has to pay the tax. Now he check whether he has a tax credit or not. He buy the new electric vehicle car that year. He got the $7,500 as a tax credit. So the tax due, the total tax that year he has to pay is $2,961. And now he to check how much he already have the prepaid the tax. The company already withhold. If it's bigger than this number, then you will get the tax refund. If it's less than this number, then he has to pay the tax. So remember, 3 key areas can lower your tax balance: adjustment, deduction, tax credit. Okay, let's move on to the last topic, investment. I know there's a lot of stuff, but now get started on the investment. Okay, 2 ways to achieve financial independence: save the money or have the money to make money. Before we cover the assets accumulation, how to save the money, here we will cover how to make money to make money, to have the money to make money. Then you have to learn investment. Why investment? First, very important is because fight against inflation. Because inflation costs money to lose the value over time. Hedging against inflation is a very important part of investment strategy. We take a cup of coffee as an example. In 1970, a cup of coffee was a quarter. By 2019, a cup of coffee costs about $1.59. I just checked. Now a cup of coffee cost average is $4.50. Especially in 2020, we have the highest inflation rate, 8% in 40 years. So after saving all those money we mentioned before, definitely should put those money to work. Fight against inflation and ensure that the overall growth of your portfolio outpaces the inflation. When you put money into the retirement account, you need to know which fund to invest. So let's see what investment option you have and how to pick. Let's find the easiest and no-brainer way to invest. Just invest in U.S. market, because U.S. has the largest stock market in the world. Its market capitalization value is 40 trillions. Compared with other regions, the U.S. stock market is more transparent, mature, stable, with more choice and less risk than other countries. Then let's take a closer look at how the U.S. market is divided. A U.S. stock category. Over time, we can see this 9 square to divide the investment in the U.S. stock market. It divides by the market value, we say market cap, and then investment style. For the market value, it's market capitalization. It's the market cap and market capitalization. So equal to stock price times number of outstanding share. And large cap are those big company, the value is bigger than 10 billion. Mid cap is between 2 and 10 billion. And then small cap is smaller than 2 billion. And investment style, we divide by the value stock, usually refer to large and stable company. They convert the earning into dividend and distribute them to the shareholder. Investment prefer the company's stable growth and fixed dividend income. The most famous index is Dow Jones Index. I think it probably is very famous. Dow Jones Index, it represented 30 largest U.S. company. And next is growth stock. is referred to those fast and high growth company. This type of company will reinvest in profit to accelerate the growth. So you usually do not pay dividend to the shareholder. They expect the return of the investor is to increase the stock price. We call it price appreciation. The representative index is a NASDAQ 100 index, 100 growth company, US company. And also the blend stock. That is a combination of a value stock and growth stock. Basically, what you invest in is the US whole market. And then the most famous indicator are the S&P 500. It's a top 500 US company. So based upon your risk tolerance level, pick one to invest, either large growth, large blend, or large value, and buy and hold to make a long-term investment. Don't trade, don't time the market. Trust me, it's hard to beat the index passive investment in the long run. I make a splash sheet to demonstrate what if you put your 401k money to work to accumulate worth. Say your salary is $100,000 and assume company have to match you $3,000. And you contribute $22,500 every year. And the average growth of the return is 10%. You know, S&P 500 average annual return since it released in the 1993 is 11.2%. So 10% is not an unreasonable assumption. From this chart, you can see within the 17 years, the 17th year, your retirement account will over 1 million. In 6 years, it will exceed 2 million. And it only takes 4 more years, from 2 million to 3 million. That's why compound interest is so powerful. Doesn't this bring you some good perspective? So reaching to the fire is not that difficult. Make good use, remember, make good use of your retirement account. Save slowly, continue investing in the market. You are soon to achieve financial independence. This is not as difficult as you thought. So, okay, that's the last slide. Takeaway point, saving before spending. Go check with your HR about your company 401k plan. Any company match. Is there have after-tax contribution to maximize 401k contribution? And then save extra to your brokerage account. Request your company directly deposit the extra money, let's say 500 per every paycheck or 200 or even 100 per paycheck to your brokerage account. And utilize your HSA, the high deductible saving account, and save more because money put into the high deductible saving account can put into the market to investment too. And also flexible spending account, the benefit that can lower your taxable income. And put money to work. Don't put in cash, put the money to work to investment. Just pick a large cap fund. If you can handle risk, pick the large growth. Otherwise, just pick a blend or value one and buy and hold. Don't trade and time the market. It's just not possible and very time consuming. Lastly, play harder. To explore the world, helping others learn our earth. So starting as soon as you graduate from the college and learning this basic of personal finance, you will kick off your adult life on more sound financial footing. With this solid foundation, you can start working toward the milestone you want to achieve later in the life, whatever they may be.